small cap outlook for 2018 and what are our favoured stock picks?
This is Matthew Booker speaking. The portfolio has performed well in the last quarter. We did have a bit of a struggle in that September quarter and into October, but we've seen a significant turnaround in our investments. We are very cash flow focused, and cash flow has effectively been out of favour for a little while. But what we've seen is a return to that, and we've seen a few takeovers in our space. AWE is one of our big holdings. We increased that holding in September through a capital raising, and that capital raising actually de-risked the business. So it took all the debt off balance sheet, and it made it a core holding in our portfolio. So it was a very big holding. It was one of the top 2 holdings. And we were lucky enough to receive a takeover offer in November. And ensuing to that, there was another takeover bid from MinRes. And following that, there was a final, or perhaps final takeover from Mitsui Group at 95 cents. So we've seen a big turnaround in one of our top positions there in AWE. It's a business we'd invested in probably in 2016, and we'd been buying as the share price had slid back. Certex was a position we entered last year. I think it's been well communicated to the market that it was one of our top holdings. It had a net cash balance sheet. It has the superior product in that liver cancer treatment market. And we believe there was significant penetration potential in the US market. What's transpired is that there has been an auction process and a takeover of that company at a 50% premium to the price prior to the bid. So we saw a significant performance from Certex as well. Also in January, we had several upgrades. Vita Group, which was another large position, Class and Adairs, all upgraded earnings. So we've had a pretty good run in January, and hopefully that continues going forward, albeit we're not focused on earnings upgrades. We're really focused on cash flow and valuation. For the remainder of the year, we're quite positive on the outlook. We think there will be more M&A activity, particularly in our space where we have our focus on cash flow. It tends to be that the predators are looking for the same things we're looking for, and that is sustainable cash flow. We do get a bit worried about the tech space and the fintech space where there are companies which are chewing up a lot of cash and they have significant market valuations. We think that sector could continue to derate going forward. So we're finding good opportunity out there in good cash flow, good traditional businesses. And that's a good segue into the next slide, which Marcus will speak to.
Thanks, Matt. It's Marcus here. Just on slide 4, we do sound one small note of caution around some parts of the small cap index. Matt sort of flagged that we have a very big focus on cash flow and valuations, and that really drives the way we think and operate. But obviously, we're aware that in small caps, other factors are at play as well, things like momentum. Quant funds occasionally dip down into our space and buy stocks where they see either stock price momentum or earnings momentum, without much regard really for fundamentals. And of course, retail investors are also looking at small caps to try and generate excess returns, which obviously, because stock price moves around a lot more than the large cap names, and in many cases that can give you good alpha, but also can destroy money quickly as well. And we're just conscious of the fact that we've seen a lot of stocks in the small cap space with some kind of speculative excess. So we've done a chart here just to give some people an idea of what's going on in the small cap space, and we've just put a simple Bloomberg screen in place saying, hey, which stocks have a market cap over $100 million and less than $2 million of revenue. In other words, they're kind of more concept-y, and I've called them disruption. I'll just joke here, are we at peak disruption? This chart here just charts back the small cap space in Australia over the last 25 years, and you can see there's now roughly 50 stocks in the small cap space with market caps over $100 million and almost no revenue at all. Many of these names will at some stage fail. A couple might become real businesses over time, but we argue that there's many people playing in this space in stocks that don't have any fundamentals to justify the valuations. And we just flag a couple of names here that are pretty popular: Buddy, DCC, Get Swift, some names people will be familiar with in the press, and at least 2 of those are currently in suspension on the back of poor disclosure to the stock market. So we remain very cautious on these kind of names. I would encourage investors to stick to fundamentals if they're dipping down into the small cap space. Turning to page 5, we also flag, we've talked about many stocks we do own in the portfolio, and some people are kind of curious about names we don't own and perhaps why we don't own them. One stock we get asked about occasionally, the name is a stock called Tassal Group, which is a salmon producing business in Tasmania. And in the middle of this chart here, you can see a graph we produce on many of our names. This is one of the graphs we produce automatically when we're doing our modeling. And it goes back and shows the history of the cash flow of the company. And as you know, we compare that cash flow generation to reported earnings of the company. And on many stocks we like, you'll see a very good reconciliation of that cash flow and the reported earnings. On stocks like Tassal Group, for example, you can see that there's been a history of reported earnings, in fact, reported earnings growth, but the cash flow, which is the dark blue line there, has been consistently poor, and over time, the stock has really failed to generate any cash flow at all. And it's these kind of businesses where there's no cash flow generation despite the earnings growth, and lots of regulatory risk around production of salmon, for example. There's lots of environmental risk around those fields. They're the kind of stocks we try to avoid unless they become extremely cheap and we see an attractive valuation or entry point. We'd rather buy stocks like Navitas, for example, on page 6, which is a good segue back to Matt.
Thanks, Marcus. Yeah, Navitas is a company we've followed for a long time now. We've never had a big position in it. It is the largest global operator of university pathway programs. So basically it sources students out of Asia and populates programs here for universities where they have a partnership arrangement. Now, it's a very profitable business, and in the past it had a big contract with Macquarie University, and that contract did present some concentration risk in the past. What happened a couple of years ago is Macquarie decided to pull the pin on that arrangement, and so there was a big hole in earnings for Navitas. Subsequent to that, they lost another couple of contracts such that they lost nearly $50 million of EBIT from the business out of 3 contracts. Now, if you roll forward from 2015 to 2017 to 2018, the actual EBIT has only fallen $25 million. So what you've seen is significant growth outside of those contracts that they've lost. So the underlying programs are growing. It's a much more diversified portfolio now. We think it's a higher multiple business. And to be frank, the future is very bright for the pathway programs, both in Australia, through the UK and through the US, where they have large contracts in all those markets. So we see Navitas as a massive opportunity. We've taken a significant position after the recent fall in share price. You can see the first half cash flow in the business. So if you look at the right of that chart, the first half cash flow has rebounded after a weak 2017. And we expect the growth to actually just to restart. So the growth is going to reboot for Navitas going forward. And it is pretty much on a value multiple now, and we think it's a growth company. So a good, strong underlying growth profile, good cash flow production, and less concentration risk in the business. So we think this is a significant opportunity, and we've taken a really large position in it. Now, moving on to slide 7, Cabcharge is a position we've been building into over the past 12 to 18 months. I think there's a myth out there that Cabcharge doesn't make money. If you actually look at the cash flow chart that we produce here, it is a very strong cash flow generator. What the issue has been is the surcharge, in terms of the credit card surcharge for the business, has dropped from 11%, including GST, to 5%, including GST. So basically, they've seen their revenue halve and their profit halve on the back of that regulatory change. Now, if you look at the Cabcharge terminal space, if you roll back 10 years, the company used to have 100% of terminal transactions in the cabs. Now they only have 20% of terminal transactions. Management has in place some strategies to regain market share in the cabs, and we believe if they can get that market share, that penetration within their own terminals from 20 to 30 to potentially 40%, you're talking about doubling the revenue for this business. And if you double the revenue for the business, the earnings will double as well. Now, there's a myth out there that taxi volumes are declining. They're actually quite stable. What you've seen is the overall market has grown. So Uber has grown the market. It has displaced taxis to a degree, but the taxi market is still stable. They are improving performance, service, and they are introducing better technology. The other side of the equation is regulation. Regulation has been against Cabcharge for a long time now. It is actually moving their way. They're protected to a degree, and they can pick up rank and hail. They can use transit lanes. They also provide disabled services. So there is regulation which is good for Cabcharge, and there is increasing regulation for ride sharing. You're going to see costs for ride sharing increase significantly going forward, and we think the supply of actual ride sharing drivers will decline going forward. CTP costs is the main one. CTP will rise significantly for Uber drivers from around $700, $800 now, which is the personal rate, up to potentially $5,000 on average. So you're going to see supply constraint for ride sharing going forward. And we think at the end of the day that Cabcharge is reinvigorating the business. They've got some plans in place. The new management team is excellent, and there's a good, strong cash flow penetration story here. at a very low multiple. The company also has no debt. It's got $20 million of cash. So it's sitting pretty, it's going to invest in the business, and we think there'll be a growth path going forward. Now I'll pass on to Marcus to talk about the outlook.
Yep. Thanks, Matt. Just on Cabcharge as well, it does pay us a very large fully franked dividend as well, so it's good defensive in our view. And as Matt said, the costs are actually decreasing for taxis in the background whilst increasing for Uber drivers. And just finish up on the outlook on page 8. Like not much has really changed in terms of our view of the marketplace. We continue to see things like M&A activity remaining elevated. There's a number of reasons for that. Cheapish debt worldwide is still driving takeover activity. Growth rates are fairly pedestrian worldwide, and you're seeing boards out there looking to continue to get EPS growth, and so they're coming to Australia to make acquisitions. We see that continuing for the next 12 months or so, providing banks and funding. The funding mechanisms are still in place. We remain cautious on what we call speculative companies or peak disruption. So the names I mentioned before, some of those stocks where there's a lot of market cap, there's no cash flow, no earnings. We think a lot of those stocks will eventually wash out and it costs investors money. So we remain very cautious on that space, as well as on the small cap financial space where we see the possibility of a poor credit cycle impacting their earnings as well. Then lastly, if the disruption we're seeing to the marketplace in the last couple of days continues, we think our funds are reasonably well positioned to ride that through. And we think they create good opportunities for, well, one, well-funded businesses, which we tend to own, to make acquisitions or buy their own stock back cheaply, or two, for us to go through and sift through the wreckage and find interesting ideas. So we tend to make quite good money relatively, and obviously good money absolutely on the recovery when these things settle out. So we see good opportunities, and we remain confident that our funds would do reasonably well through that period of time. And just to conclude, on page 9, we just give you a quick summary of both the main funds' performance. And you can see this is the figures to the end of January. So we had a very good month in January. And just to reiterate Mark's comments earlier on, since inception, both the Small Companies Fund and Microcap Fund have materially beaten their benchmarks. These are all post fees. And we think that what we're doing in terms of fundamental research and controlling the amount of money we'll take into funds will generate sustainable returns for clients looking